This bounce may go down in history as one of the longest, if not the longest, bear market bounces in history.
In today's video, Harry Dent, author of 0 Hour, talks about what's up with bonds, the next moves of the Fed, the raging inflation and the coming recession. Dent has been predicting a great reset of the biggest financial asset bubble in history. The market historian predicted a painful crash in stocks and an economic depression, and discusses the next moves before the big crash. He believes that the top is in and the Fed is tightening aggressively. Could the markets make a new high?
This bounce may go down in history as one of the longest, if not the longest, bear market bounces in history. Now that's assuming we did see a top in late 2021, which it still looks like to me, looked like back then and looks like now. But this bounce has lasted 8 months, even more on some indices, and has gotten within 5 to 10% in some indices of the all-time highs. I mean, this should not have happened, okay, in an economy where the Fed has just raised, since March of last year, 525 basis points, the largest raise since this boom started in the early 80s, way back, okay, and is likely to go another 25 basis points. It may not, but still, that's the most likely, I'd say still. 550 basis points. That is going to cause a slowing, okay? There's just no two ways about that. And one of the things I think that's confusing to economists and a lot of investors is that we have two things going on here at the same time, okay? I've been saying this over and over again. The Fed finally made a huge mistake overreacting to the short-term COVID crisis, okay? You know, to raise rates that much on something that by definition, like the influenza in 1918 to 20, would last about 2 years and wear off on its own, which it did, okay? So they raised rates far too much here only because they loosened so far and stimulated $5.2 trillion rise in the balance sheet, the biggest ever. And in 2 years, it took 6 years to raise it 3.6 trillion in the first big round of stimulus after, from 2009 forward. So in 2 trillion, 5.2 trillion, 25% of GDP. So see, that was the big mistake, overreacting to COVID. So now what do they have? Okay, now we have this rise. I'm telling you folks, it hasn't hit yet because that 5.2 trillion between, in the last couple of years is still hitting on the positive side, although that is due to wear off soon and fast, okay? I mean, they wouldn't have had to do anything and that would have worn off, okay? They wouldn't have had to tighten, okay? And then at the same time, this tightening that started in March of last year and looks like it's probably gonna peak maybe on the next rate rise, okay, just ahead, that's going to take over the next year to hit. So I've been stressing lately, this is the battle of the lags, okay? The lag in the biggest short-term stimulus in history by the Fed and central banks around the world at 5.2 trillion in 2 years, okay? That lag still hitting before it wears off, and rapidly when it does, with no more to follow. And the lag on the new tightening in the last, say, 14 months or so, that will probably go a little more, maybe another quarter point to 550 basis points, give or take. And that's going to take a year plus to fully hit. But the point is, the lags both go in the same direction now. The stimulus wears off rapidly in the next year plus, that's a negative, and the tightening hits in the next year plus, that's a negative. Folks, we are going to slow down here. And there has never, ever been a soft landing in history after a long expansion. And guess what? This is the longest expansion we've seen, okay, in 4 or 5 decades, okay, without a recession, okay, from 2009 into recently, okay, the longest one, okay. So this, you don't get a mild slowdown after an expansion this big. And on top of that, this is the only expansion in the last 4 decades that has been 100% artificial from stimulus only. Not from demographic trends, okay? Not from normal productivity, from a population aging into higher spending and productivity levels, okay? So again, this is going to be a surprise. I think people are being fooled by the market saying, okay, yeah, maybe we will have a soft line. Oh, this tightening hasn't affected that much. Wait 1 more year is what I'm saying. And now, so we're left with 2 short-term scenarios, okay? That the markets do follow through and we see another wave down of stock crash, and that target is very, very clear on the target, on the charts, okay? The COVID lows in like late March 2020, okay? That is going to be 50% or more in most indices, and that, as I've been saying, will finally tell investors, oh no, we're not in a deep correction, we're in a crash of our lifetime, okay? And that's what I still think is the most likely scenario, and that is unquestionably the best scenario for the markets and the economy. We can't have this millennial boom, which is already set, and I've already telegraphed decades advanced, just like the baby boom from 83 to 2007. That boom is from next year, 2024, into 2037, the next big surge from them, and then it's kind of flat after that, okay? So if we're gonna have that next boom, and it's gonna be healthy, we need to clear the debts from the baby boom generation and all of this crazy stimulus, especially this stimulus since 2009, which came in a slow period and had no fundamental trends behind it, okay? So this is, we're gonna see pretty soon, because if the markets are gonna continue down, they should turn down in wave 3. We've seen wave 1 in 2022. Wave 3 should start hitting from about now. I think it may have already just begun, into late this year, early next year, and take us again back towards those, if not to the COVID lows. And that's when we know we're in the crash of a lifetime. And even in that scenario, there should be 1 more wave after a bounce that would take us even farther down, probably into mid to late 2024. And again, just to summarize, and more in the newsletters ahead for subscribers, I'm seeing that all of this stimulus here has offset this long-term scenario that by natural trends would have bottomed around late 2022 for stocks and 2023 for the economy. Instead, we have the bottom in stocks mid to late 2024 and into early 2000 to mid 2025 for the economy. That's the best scenario now. We'll see if the markets turn down. If the markets do not turn down and we have the preferred scenario, the best for the economy, then we will be in, I'd say, a long-term, more narrow range. We'll probably never really see a substantial new high for the next decade or so, and we won't see substantial new lows here. It will just go sideways in a very mediocre economy. Folks, that's not the best scenario. We need to take our medicine and move on and give our kids, for us baby boomers, the millennials, a chance to have their boom from 2024 to 2037. I'll keep you updated.